Ladies and gentlemen, welcome to another edition of In the Pit with Lobo Tigre. Our victim of the day is Brett Heath. He's the CEO of Metalla Royalty and Streaming. Now, Brett has a really interesting story. This is a very apropos time to talk. Major news out of the company yesterday. But just a quick view is this is an up-and-coming royalty company that most of you know about. So, Brett, why don't you go ahead and give us a quick overview of what's going on, and then I've got questions for you.
Thanks, Lobo. Thanks for having me on. Again, it's been a while since we spoke, so always good to provide a nice update. And happy to say any buyers that came in before should be pretty happy shareholders, or at least we're happy shareholders here. So we're a precious metals royalty company. Started in September of 2016, so coming up on 4 years. We've now completed 17 transactions, and we've acquired upwards of just under 50 royalties. So we've been able to grow. We've been able to prove out our model. Our model is a bit different than the peer group. We focus on existing royalties, which is important to understand. We're not giving capital to the mining companies for the most part. I mean, there are potentially a very select few that we believe in from that perspective. But really what we're doing is we're buying these third-party royalties on very high-quality assets that are operated by the largest mining companies in the world, that have the balance sheets, that have the skill sets, the people, the personnel to move these projects forward, advance them, and that inevitably results into more value for the shareholders on a per share basis, as we can pick these things off on an accretive basis and use our platform to generate value.
Okay, well, that is a good overview. And just to clarify, when you say existing royalties, you mean royalties that you didn't generate, that were already out there and that you're buying from a third party. It doesn't necessarily mean a producing, cash flowing royalty now, though your latest acquisitions are changing that. Is that correct?
That's correct. That's correct. So we like to target royalties from some of the biggest that are on some of the biggest mining companies' projects or mines in the world. And these big mining companies, they have plenty of access to capital. They've got billions of dollars of liquidity, and they're not going to be writing royalties on their own assets. So this is a way that we can get in and give our shareholders exposure to a very high quality type of project, but have a much more robust vehicle of growth. I mean, if you're investing in a major mining company, these are well-established companies. They're huge. They're, tens of billions of dollars, and they're not going to really be a big kind of growth factor in your portfolio. They'll give you a nice kind of stable kind of market precedent in regards to return for gold equities. And that's kind of really about it. And so to be able to invest in a high growth, much smaller company, but I would say from a much more attractive risk adjusted standpoint, because you're not only getting exposure to these projects that are owned by these really big operators, but you're also getting the royalty exposure, which is just a phenomenal business by itself.
Right. So, you didn't quite start out this way. I remember you picked up some fairly modest royalties at the beginning, and you told me you were going to go after these bigger royalties, more significant royalties, and you did, which is why actually I did buy the stock back in the day. I had a huge win, I have to confess. I took my win, I booked the win and ran. But you're kind of hitting it out of the ballpark here lately. So why don't you you have a bunch now. We can't go through all 50. So why don't you talk to us about your two most recent acquisitions, which seem really significant and perhaps game-changing for your story?
Sure. So the last acquisition that we just announced was a royalty that we picked up on a mine called Wharf. And this mine has been in production for about 3 decades. Believe it or not, it was actually one of the first mines that Rob McEwen bought inside Goldcorp and levered to build that whole company. He levered off Wharf to buy Red Lake. It's got a long history of producing a ton of free cash flow for the underlying operator. Coeur Mining bought this asset in 2015 for $100 million. 5 years later, it's generated upwards of $175 million in free cash. So definitely, I would say one of the best from a free cash flow perspective. And that's what you want to see as the royalty holder. You want to see mines that make money. You want to own royalties on mines that make money. Those are inevitably the safer assets. Production history is great, going back 30 years. And this royalty is in the United States. So it expands our footprint, again, in a tier 1 jurisdiction, is immediate from a cash flow perspective. The royalty pays monthly. So this is, starting July. This isn't starting out 6 months or a year. And what it does is it really kind of sets the bar for, I think, where this company is transitioning. And as we built this portfolio, we took a much longer view than I would say you typically see in this business, and we really focused on the high quality assets. And what we had to do from that perspective is we had to really build up a foundation. And the easiest way we saw that was really buying the development assets. But what we're finding now is that now that the company is at critical mass, and it's so compelling from a growth perspective, that we're starting to get some of these, these existing royalty holders that are willing to exchange their royalty for equity in our company, and these royalties are generating cash. They're generating cash today. There's much, much bigger ones out there that we're after. But really, I think it's the patience and the persistence and really the long-term vision of not getting distracted, not getting pushed around by what you typically get from investors, holding your ground and building a really solid company. That's what we've been doing since the very beginning. We have, gone on a very, very straight line in regards to, what we said we're going to do, and we've been able to execute on it.
Actually, let me jump in there, Brett, for a second, because I think that's significant. And, maybe, frankly, it's part of why I decided to take profits when I did, is because you did have this long-term view. You bought a lot of assets, or bought into these royalties from future production, and you're paying dividends. You weren't earnings positive yet, and a lot of the upside seemed to be in the future, and that's not bad if you have the staying power to get there. But you kind of worry a little bit. It would be nice to have a little bit more cash flow, especially with Endeavour spooling down there in Australia. And so the critical mass thing here seems really important. You've switched really from, it's not that you've abandoned that previous model, but you're at a point now where you can buy something that's much bigger and cash flowing now, which you really couldn't have done 3 years ago. You wouldn't have been able to pull off the same deal when you and I first met.
I would say that's correct. Endeavour was, at the time, that was a transformational deal for us. It ended up being a phenomenal return for us. It was a short mine life, but it was really chunky cash flow out of the gate. And we were able to buy it at an attractive price. And that's really the kicker here for this business. And if the royalty company that you own can consistently buy high quality assets that are accretive, then as the portfolio grows, it becomes extremely powerful. It translates into an enormous amount of shareholder value. And these development assets, I think really those are going to be some of the real drivers of growth going forward, because we're seeing huge amounts of reserve and resource increases. The typical deal that you see from a major royalty and streaming company writing a check to a mining company, the returns that you normally get from market precedents over the last few years are very little. They're basically providing gold price optionality, and that's about it. And what we're seeing, buying some of these development assets, we're able to target these assets right before they experience an enormous amount of growth. And what that means is these mining companies are going to be spending 10, 15, 20, 30, 40. In the case of the La Fortuna royalty that we picked up earlier this year, which is a Tech Newmont JV, they're going to be spending $152 million drilling the project over the next 4 years that we just picked up a royalty on. So the amount of real value that you're going to get, I mean, even though those assets aren't in production today, I think will translate into a huge amount of value. But, more importantly, the portfolio is now compelling enough where we are able to get some of these holders that have these assets that are cash flowing. I think you're going to see more as the company transitions here.
Right. Well, that's a good segue to this last deal, because you paid what, $8 million, but you only had to pay one of those in cash, and the rest was shares. And people are willing to take those shares because they believe in your trajectory, presumably.
That's correct. And the reason why they take those shares is because we've now done, like I said, 17 transactions, and the majority of those have been share-based, and every single one of those shareholders have made money. Every single one has made money.
Yeah, hard to beat that. Okay, so this deal with Kerr and they're exiting their position and they're buying part of the royalty that you're borrowing. Can you explain this in simple terms for our audience here? They're smart people, but it's a complicated deal. Can you make it simple for us, please?
I will try. It is a complicated deal. We're really excited about it. We're really excited to have a case study on a kind of a really proof of the model from start to finish. So Kerr came in to our company. They sold us a non-core royalty portfolio back in 2017. They became our largest shareholder. They came in at about a little over $2 Canadian on the stock back then. I think it was about our third or fourth transaction since inception. And they've held the stock. They've held the stock for 3 years. And they were able to get a very nice return, over 300%. And eventually as a big mining company, they look for liquidity. They accomplished their goals. They used Metalla, and Metalla was able to maximize that value for them. And as part of that, the shareholders as well of the company got a really great return as it. So it works both for great parties. This transaction was a bit unique because the royalty that we were buying was actually on one of Kerr Mining's operations. And so we were able to work with them on this transaction, which I think further enhances our model, because what we did here is we found that existing third-party seller, and we were able to buy the royalty, but we were able to partner with Kerr and allow them to reduce a portion of it while Metalla still got enough to make it a very meaningful impact for our portfolio, or the majority of what was there. So that gives us, I think, even a further edge, specifically with our peer group, because that's really never been done before in the royalty business.
Yeah, it was interesting. So I can see why Kerr would be interested. They can reduce their overall royalty burden. They're buying back some of the royalty that it's better for the mine. What did you get out of that?
Well, we got a phenomenal royalty that I think.
I mean, but you would have bought it anyway. You're not buying it from Kerr,
So Kerr, as part of the transaction, Kerr had a right of first refusal on the royalty.
Ah, okay.
Yeah.
There you go. So you got them to go along.
So we got them to work with us, and as a function of that, we also got them liquidity, and we got a great case study, and we got a number. We use this to our advantage, because when we announced the secondary with the deal, we were able to bring in a half dozen really solid institutions, get their toes in the water. We believe that as we continue to execute, now that we're on their screen, these are really big funds that are going to be able to buy a lot of stock and increase those positions kind of from a multiple of what they picked up. A lot of times you need to give them a little bit of a discount. And that's why, we priced it to kind of pull them in there. But this isn't treasury shares, right? This is secondary shares. So the share count's not changing from that deal perspective. We're just increasing our float to the tune of just under 15%, kind of what we announced this morning, about 12%. We're going to have an increase. That's going to bump our liquidity, and I think that's going to drive us into some of the ETFs, which I believe will create a nice tailwind of buying into the second half of this year.
Right. Just to be clear for the viewers out there, what he means by secondary and not new issuance here is that these shares were held by Kerr. They weren't trading. They're off the market basically. So now you have a large block of shares. It's not new shares. They didn't create new ones. But these ones that were off the market are now on the market, and they'll be trading and adding to the volume for the stock.
That's correct.
Okay, all right, very good. And I'm not sure if you're allowed to make a forward-looking statement here of this kind, but can you say starting to pay in July, how much do you expect to get paid every month? Is there a round figure you can give us, a corporate expectation?
Yeah, I mean, we haven't obviously provided any company guidance. If you look to kind of where we've got 4 analysts that cover us now, and I would say kind of the average that they project is pre-tax about $1.5 million a year US. So I would, instead of the company making that statement, I would look to the four analysts, but and the company will make its guidance at the proper time to the public market. But it's a solid asset, and more importantly, it's proof of the model. These are not easy royalties to buy. The sector has become a bit more competitive, and it's important to understand that. And this is also, I think, a really big competitive edge. I mean, we've seen kind of just a lot of new competition. A lot of people saw Metalla, they saw Mavericks. This is an easy model. We've got a couple royalties. We're going to start a royalty company. We kind of see this every 5 or 6 years normally. These transactions are ones that we've been working on oftentimes for 2 or 3 years, since even before this first time we spoke. So we're really confident in where we're at on a lot of these deals, with a lot of the relationships with the holders of these existing assets, and really the compelling story because of our track record. And it all comes down to discipline. It just comes discipline on making sure we buy assets that add value for you guys, for the shareholders.
You're singing my song there. Discipline is sort of one of my mottos. All right, well, let's talk about the IRC Zeke deal. You have bought you've bought the royalty on a large package adjacent to the Gold Rush project. And I remember how excited you were at the time. We set up this interview because of this, not the new deal. So let's talk about this. I looked at the maps, and it looks like there's a little bit of the current resource that goes under your ground. Is that right? Is there actually, when I first looked at it, I thought, oh, okay, exploration upside on the Cortez Trend. But then when I looked at that map, it looks like there actually is current resource on your ground. Is that correct? And talk us through what you see the value added being there.
So this was a deal that I thought was going to get a lot more attention. We were significantly more excited about it than I think kind of where the market reacted. And you are correct. So that there's no defined reserves or resources that Barrick or Nevada Gold Mines, the current operator, have reported publicly that we can state. But there has been drill holes that intercepted significant mineralization on what is known as Gold Rush South that actually crosses over onto a part of the Anglo-Zeke claim. Gold Rush South was being drilled, and they actually stopped drilling that. They didn't stop drilling it because they weren't hitting mineralization. They stopped drilling it because they discovered 4 Mile. And they brought the drills up there. And that's just 4 Mile and Gold Rush are right next to each other. And we think, and the information that we're able to look at from a public perspective, and also through our own technical internal perspective, we think that is one big project. We think Gold Rush, 4 Mile, they just made a discovery just to the north of 4 Mile, about a kilometer north. Gold Rush South, again, where the mineralization hits us. They're going to be drilling. We think they're going to be drilling Gold Rush South once they complete their exploration decline. In another, probably towards the end of the year, they'll complete it, and they'll probably focus on the main parts of Gold Rush first, and then move their way to the south. And we think that that southern part is an extension of Gold Rush. More importantly, there's been a number, I guess two other drilling intercepts that have located that same stratigraphic structure that hosts Gold Rush. Gold Rush was not there and unknown because it was under 300 meters of volcanics. There's no outcrop. You can't do the typical things that you do from a technical perspective to find this, except stick a very expensive hole in the ground and hope for the best. But once they find these types of structures that hold this mineralization, then they can take a much better educated guess. And we believe that there was one found just to the east of Gold Rush based on current disclosure from Barrick in their last quarter. And we believe that also there has been a structure that was found on New Legacy's property that are the exact same structures that host Gold Rush. We believe both of those will continue to be drilled over the next 12 to 24 months. And that is how you position your shareholders for these elephant royalties, if you will. They're not for sale once they're known. Once that drill goes to the ground and it goes through that type of mineralization and you get these type of results, these royalties are off the market, or if by any slim chance they're on the market, they're definitely going to the major mining companies at very high valuations, well far out of reach of Metalla. So part of the royalty business is really positioning your shareholders for this type of optionality. And it's not easy to do. And it does require a lot of patience, and it does require a number of really irons in the fire, because it is exploration, and exploration's tough. But it's better when, instead of investing in maybe an exploration company that's got one project, you've got a royalty company where hundreds and hundreds of millions of dollars are being spent on these projects, drilling them, looking for these types of deposits. And the way that you get lucky is you pick up 190 square kilometers across one of the most prolific trends on the planet. This is 4 times the size of Manhattan. If you look at the trend of Cortez, look where they started and look at the different discoveries that they've made. Everything points to the southeast. We picked up 190 square kilometers on an extension to the southeast, and we think there's more there. So we're excited about that. We think it's a very strategic asset. We're really happy to bring in more new shareholders that, were the original royalty holders became shareholders as again, part of the model.
So, but this is a bit of a departure for you. It's not a development project. This is earlier stage. Granted, it's elephant country. So if there's something there, it's going to be really big. But it would require some patience. I mean, the exploration has to happen first before, let alone development or cash flow.
Yeah, that is correct. So on certain types of situations, specifically to this one, when we had a chance, this royalty has been held by the same family for 30 years. Okay. So these things, there's only so much beachfront property, right? Like whatever way you want to look at it. And once it's gone, it's gone. And particularly if it goes into a royalty company, it never comes out. So Nevada is ground zero for royalty companies. I would say it's probably one of the hardest places to find good royalties because it's the big royalty companies that's where they built their business. And you really need a piece of Nevada. And we've been wanting a piece of Nevada for a long time. So when this opportunity came up, we're really happy to pursue it. And it provides that type of optionality that I think will, and this isn't pure exploration, obviously. Like we have a high degree of confidence based on the technical work we did that they will find it. Now, when that comes into production, we don't know. But I do know that if you would have owned the royalty ground over Gold Rush in 2005 until today, there's still not 1 ounce that pulled out of the ground, but that royalty value would have gone up by 100 plus times.
Sure.
So it doesn't necessarily need to have production tomorrow to be able to generate the return for the shareholder.
Understood. Okay. All right. So you do have a lot of pokers in the fire. That one's perhaps a longer term one. There's a lot going on. Can you sort of give us a snapshot in terms of the company's operations right now? How many cash flowing royalties do you have right now?
So we've got 4 cash flowing royalties right now. We've got Joaquin and Cozy down in Argentina, New Luica, which is in Tanzania, and then now Wharf, which is in the U.S.
So Endeavor is shut down entirely.
Yes. So Endeavor went to care and maintenance at the end of 2019, December 2019. For Metalla, we continued to get kind of the final settlements of the concentrate kind of through the calendar first quarter, and then now it's completely off. And we have stated publicly that Endeavor has decided to look at different options to monetize that asset, including a potential sale. There's there's 2 really kind of main options for the future of that asset, which is the deep zinc lode and also an open pit scenario. We don't know, what their plan is. We know that there's still quite a bit of value there. You've got, an asset that's got all the infrastructure it needs to really turn production on within 12 to 18 months. The base metal prices definitely aren't helping with lead and zinc that are not incredibly strong. It's a lead zinc mine. Our portion of it is silver as a byproduct on the stream. So we think that we will. We think that there's a good possibility that moves into another owner that ends up putting more capital and bringing it back into production at some point. It was shut down in 2015 and 14 because of low base metal prices, and it turned back on and was generating a ton of cash. So, not to say that it can't do it again, but that again it was a great asset at the time. It provided a great return for the company. It allowed us to return cash back from a dividend perspective. And
yeah, you made, really, as I recall, you made more than twice what you paid for it, right?
It was just about. It was a great return for the company, and we're really happy with the deal. And even from Core Mining's perspective that sold us the asset, even though it was such a great deal for us, they made even a multiple of that on the equity.
On their shares.
Yeah. So there you go. That's the business
that's it.
model.
So I was concerned about, you had ambitions, but you had this decrease in cash flow, and Joaquin and Cos were coming online, or Cose, if you will. It's an acronym, but they're small. So I was worried. Now I'm not worried. Now that you've got the Wharf deal going, but I guess the whole situation just changed. But can I ask, do you expect, the forward-looking statement, don't put a number on it, but do you think you'll actually be delivering to the bottom line this year, or is that still for the future when more projects come online?
Well, what I would say to the bottom line is that, a bit of the bottom line for royalty companies' perspective is in the way you would originally kind of think about it. And that's because the way that some of these assets are structured from a tax perspective, there's heavy depreciation. I mean, if you look at an operating cash flow perspective, we were generating cash, for most of the time when Endeavor was in production. We were generating free cash. That was put against depreciation and non-cash items in order to structure those in the best way possible. But we were operating cash, and we were cash flow positive from an operating perspective. I think as the company transitions, yes, it's going to move in that direction. So I would say that this is a major step, but it's a major step to understand really kind of the transition and the trend within our company and the assets that we're going to be able to buy in the future, compared to kind of what we really had to focus on in the last 3 or 4 years as we were building up and building that critical
Sure.
mass.
No, I understand that, and just I'm not too stuck on that or hung up on that. I get that from a shareholder's perspective. What I want to see is added value for shareholders. And if I'm a
Mm-hmm.
shareholder and my shares have gone up, I've got that added value. How can I complain? But at the same time, you're not quite the startup that you were, 4 years ago. And you do have significant cash flow, more coming online, and so at some point one would say, okay, all right, you're grown up now. You should deliver to the bottom line. So maybe a corporate goal for when that might be.
So, I mean, if you look at we have one of the most robust development portfolios. We've got a good 5 or 6 different assets that are likely going to be that we've already bought and paid for, that are likely going to be coming in production in the next 3, 4, 5 years. So there's going to be a lot of cash flow coming in the future, as these assets, they're all being advanced, they're all being pushed forward, they're being developed. Most of the companies, if not all of the companies, have zero financing risk. When they're ready to build a project, they either build it out of free cash, or they have that on their balance sheet. So that's a huge advantage from understanding from a risk perspective, because if there's a junior that needs to, it's $100 million market cap and it's got to build a mine that's 300 million, that's not going to get built. It's not going to get built. Maybe a much, much better gold market, maybe when their equity returns, maybe there's lots of risk in that situation. But when you have, the Agnico Eagles, the St. Barbaras, the Newmonts, the Techs, these companies, they do their own internal studies. They go through the process of development, of permitting, and when they're ready to build the mines, they meet at the board level, they allocate the capital to the project, and they build it. And they've got all the people all ready to build it. They're not trying to go and find some contractor and toll mill down the road. None of that works in my experience. It all ends up in quite a bit of tears. But if you focus on these really solid projects, they will come through, and eventually that will translate to the bottom line. There's kind of zero doubt in my mind as we continue to grow this business.
Okay. So another question I have, again, it's a growing up kind of question for you here. I remember you explaining to me earlier on when I was asking you, why are you paying dividends, especially a small, measly little, dividend when you're operating at a loss? And you explained that a lot of these vendors, little vendors, not big ones, they wanted a dividend. That was part of the deal and part of what was enabling you to land these deals. But now that you're transitioning, now that people can see that, getting shares in this up and coming royalty company is perhaps more important, do you still need to do that? Does your outlook on dividends change, or do you increase the dividends as your cash flow goes? What is your strategy with these dividends going forwards?
So the strategy has been the exact same since the very beginning. Even before we had the Endeavor cash flow, we had actually a dividend strategy before we had cash flow. And one of the things, I mean, I came originally from the buy side, and when I put up my capital, my investors' dollars, into an asset to support a company to build a mine that I thought was going to be a profitable mine, and that ended up becoming a very profitable mine. The one thing that I could not stand from some of these management teams was that they would take all that value. They would take $100 million of value out of one hole, and they would leverage it and put it down another hole. And they would try to grow the company. They had a really great asset. They'd go buy a marginal asset, and none of that cash, the shareholders would never see a dime. And we see this over and over and over again in this business. And it's really unfortunate because, the really great assets that, it's hard to make money mining. And when you have a really good asset, it should translate into at least something coming back to the people that supported it and really put up the capital to build it. And so from a growth perspective, paying that dividend didn't really do much at all to impact our growth. We paid out just under 2 million Canadian. I think during that year we put to work just under 40. So zero impact on growth. Like it had literally nothing, no overhang, because a lot of times the argument is always, well, if you're a growth company, you should be using that to grow, right? But the thing is that we've got our model allows us to use our equity to grow and exchange that equity for very high quality assets. And when those assets come online and they generate that cash, then the target is always 50% of that operating cash flow goes into the dividend. The other 50% goes back into the business to buy more assets that, eventually as this company does grow and as all these assets come into production, then at that point, the amount of equity that we're going to have to give out is going to become lower and lower and lower and lower to the point where, a large chunk of it in the future will be driven by cash. And obviously we're always going to have an equity component because that's our model, but it'll continue to probably trend lower as the company gets bigger, which is going to provide even more upside for the shareholders. So that's always been our model. Like if we're generating something and we all have positive cash flow, we'd like to give some of it back. And if we don't, we did pause dividends during the COVID. The assets were being shut down worldwide. All the companies were putting guidance. So it's not to be looked at from RBC or General Electric or one of these companies where you're solid state dividends. It's no, like this is a little piece. It also is another element that provides discipline from an acquisition perspective, because you can't go out and pay huge premiums on assets and then try to pay a dividend off it. It's just the arithmetic doesn't work. If you're going to be paying a dividend off an asset and provide a return, the numbers need to work. So it's also another level of kind of discipline that we have with a number of different things that we look at on every single deal that we do. So far, I think it's worked really well.
So that is interesting. It's again a bit of a transition, but maybe not. You're saying you basically had a philosophical inclination in this direction anyway, in terms of you thinking it's the right thing to do for shareholders. Whereas before you needed those dividends to get some of these deals done. Maybe now not so much, but you still think it's the right thing to do, so you're going to keep doing it.
Yeah, it is a benefit as well on the transactions. It adds the royalty business. It's such a just phenomenal business. It is highly competitive. It's highly competitive with the big companies, and then as we discussed, there's been a number of new companies, and you just have to have that laser focused business model that really kind of sets you apart from the peers in order to really grow.
Well, let me jump on that, Brett. That's the natural segue. I have to wonder. There are a plethora now of little junior royalty companies. So you don't quite have the sector to yourself the way you did before compared to the big guys. But there are really only a couple of names that really seem to be rising stars. Yours is one. Ely comes to mind. If you guys had side-by-side booths at a show and I was an investor looking at you guys, why would I pick your stock over theirs? Can you pitch me on that?
Well, I would kind of, again, I would expand it to the whole peer group. If you look at the transactions that we've been able to execute, you look at the number of transactions that we've been able to execute from a track record perspective. We've completed more transactions than the peer group. We've continued to add very high quality assets, I would say, than the peer group. So that includes kind of all of the smaller companies. And so really, it's about track record. You want a company that's going to stair step higher and continue to grow. and continue to kind of show that growth and that value accretion on every single deal. I think Metalla overwhelmingly has been able to execute from that perspective.
All right. Well, you're being very polite, not throwing anybody under the bus. I'll leave that at that. Let me ask you one more question. Again, imagining that we're standing there at the booth in the show, and you're trying to persuade me to put my own hard-earned money into this deal and buy your stock. How much of your own hard-earned money have you put in there? How much skin in the game do you have, sir?
All of it. Everything that I have is in this company. So every decision that we make from a management and a board perspective are from an owner point of view. That's important. I mean, you've obviously noted that as kind of a key factor in how you look at any single type of business, but the majority, and not just the majority like 51%, but pretty much the majority like 90+% of everything that I have has gone into this business. And if you want to pull the insider filings, you'll see consistent buying by me and some of the other directors, all the way up until we're blacked out. So
on the open market, that is notable. Is there an official management and insiders ownership figure?
Management is kind of in between about 4 and 5%. From all of management.
All right.
Which used to be a lot higher, but as we continue to grow the company, obviously we're we own kind of a bit less, but we're happy to own a bit less of something that's worth a lot more. And again, we see, and we've been able to see the value of these shares go up because we're doing transactions that we feel will add value to the shareholders on a per share basis. That's really all that matters at the end of the day.
Okay. I give you one freebie here. For another forward-looking statement, I know that you can't discuss what's confidential under these things, and I know you. Every time we talk, you always tell me you're working on several deals. Watch this space. Can you say how many deals you're working on right now? Like, rather than tell me, okay, we're going to close this then, or anything you can't tell me. I'm not asking for that. Can you tell me how many new pokers have you got in the fire right now?
Well, I mean, what I'll do is I'll just give a quick summary of kind of how we look at the pipeline and really the benefits that we have to give you and allow you to make kind of your own judgments.
Your lawyers will be happy. Okay, go ahead.
So one of the clear advantages that I believe Metalla has buying existing royalties rather than going after, originating them, providing capital to mining companies, is that we know all the royalties that exist already that we want to buy. So our list is quite long. We know the universe inside and out. We know the holders. And I mean, at any given time, there are, I would say, over 100 different opportunities in the universe that we want to buy. And it's a function of timing and for a lot of these holders, and it's a function of size for Metalla. And really, we have, I think we've really kind of put together a good system in place in generating these and pushing different ones forward at different times. And we've been able to consistently average about a deal a quarter since inception, which is almost about 2 times the peer average. And I think we'll continue with that. So that's as much as I can give on that front. But it is a really clear advantage that we have, knowing all of the transactions that we have, having 4 or 5 years of visibility on the pipeline. That's a tremendous advantage in this business. If you're providing capital to a mining company, you're following these projects through the de-risking cycle, and then there's a critical event, whether it's a PEA, a PFS, whatever it may be, that really kind of checks that box. And then that is your timeline or your really visibility to make that investment. The problem is that the good projects, you've got equity that comes in, you've got debt that comes in, you've got the other royalty companies that come in. If it's a good asset, you've got an enormous amount of competition that's really all trying to be part of that capital structure. And instead, from Metalla's perspective, we can see further out. If we look at a project that we really like, that we think will go into production, we can go maybe a year or two before that critical event happens, and we can buy that royalty from an existing holder and get the benefit of the next 2-3 years of value, and also buy it at a much more attractive price than when the capital providers come in. So
if
sorry
you,
for the
if
long.
you have the patience, and if your shareholders have the patience, which now with your track record they should. Okay. All right. Well, that's, I think, a good positive note to wrap up on. Congratulations on the Wharf deal, and keep us posted.
Thank you. Well, thank you for having me.